and knowledge in entrepreneurship. As you're going to see in the chat in just a moment, the Nasdaq Center provides programs, resources, and exceptional mentorship to entrepreneurs across all races, industries, and geographies. So check out those links and resources in the chat. A couple of housekeeping items before we get started. Firstly, let us know where you're dialing in from in the chat. See if you have a neighbor. Secondly, we're going to open up for live Q&A at the end of each panel. So please submit those questions for us in the Q&A function at the bottom of your screen throughout each presentation. We'll try our best to get to them all. Now, none of what we do here at the center would be possible without all the amazing support from our sponsors, including Nasdaq, Lehigh University, KPMG, Wilson Sonsini, Wells Fargo, the Noreen Foundation, Walmart.org, JP Morgan Chase, BPM, HubSpot for Startups, and Google Cloud. We're humbled by their contributions and hope you're grateful too. Now I'm going to launch a few polls to take a step back and take a temperature gauge on how everyone's doing today. My first poll is going to be around how are you feeling about your business right now? So I'm going to launch this poll real quick. We use this to fuel the engine that is our wellness programs and resources that we provide for you, our entrepreneurs. So how are you feeling about your business? Are you optimistic and a little bit of survival mode? Let us know. Thank you for voting. I'm gonna let this run for another second or so. Well, looks like optimism is the leader, but understand there's a little bit of survival mode and anxiety out there, so we'll get to it and hopefully help. And hopefully our panel today will help as well. Our next poll is going to be what side of M&A are you looking to learn about today? So I'm going to launch this poll, just navigating this one. Oh, no, the second poll is what's keeping you up at night? We also use this to fuel the next couple months of programming that we have here at the center for you. So let us know. Is it finance, sales, marketing, scale? Let us know, and we will get to work on chasing these topics for you all. Righty, thank you for voting. Looks like finance is in the lead. All right, I'm going to end this poll. Share those results. Thank you for voting. Looks like finance is in the lead, and you're in the right place because that's what we're going to be talking a lot about today. So thank you for participating in that poll. I'm going to cover a little bit about the agenda. So we're going to kick off our program with our market update, and then followed by a panel on M&A strategy for early to mid-stage entrepreneurs. We're going to have a quick 5-minute break, then transition into our fireside chat on HR and talent integrations through the M&A process. And in our last panel, we're going to share insights on growth through acquisition, our buy-side overview and insights panel. The same Zoom link is going to be used for this entire thing, so if you have to drop in and pop back in, all good. So without any further delay, please join me in giving a warm welcome to our first presenter to share our M&A market update. Dan Rossi is an executive director of tech M&A at Morgan Stanley. Dan, welcome.
Hey, thank you very much.
Thank you.
All right, I'll take it from here. So I've been with Morgan Stanley for the past 6 years, been doing M&A for over 10 years across a couple firms, and have done over $250 billion in deals across all sectors in technology, deals of all sizes, all types. So I'll share screen and get going. So first thing to hit on are some of the key themes that we're seeing in the technology M&A market today. And the first is a real recovery from the trials that we've seen in 2023. And this is largely driven by a couple of main factors, the first being stabilization in macro, and the second being softness in the IPO market. So as firms are looking for exits, M&A is becoming a much more viable alternative. Second is we're seeing a combination of improved CEO confidence, improved financing markets, and then declines in target prices. And all of this is conducive to a more active deal environment. The next is that sponsors and tech strategics were largely driving the M&A wave that we saw in 2021 and 2022 and through 2023. But what we've seen is a lot of strategics, whether they be private to private or public strategics targeting other publics or public strategics targeting private companies, that's really strengthened, and we expect that to continue through the rest of 2024. The next is we're seeing a combination of some, we call it new technology. It's a little bit of old technology being used in terms of deal structuring that's affecting deals. We've seen Microsoft and Amazon do that. I'll get into that later. And then we've also seen an uptick in private to private transactions. So this mega theme of companies using more complex structures to get deals done. And then the last is that the antitrust environment, it does remain challenging, but deals are announcing, and importantly, they are closing. So from a macro perspective, just to touch on this quickly, what we see is broad stabilization across key indicators. Some indicators are showing some choppiness, like unemployment, treasuries, and Fed funds, which have increased, but we do expect rates to come down, which will be conducive to M&A. And the elephant in the room being the presidential election. On the one hand, we do expect more of a continuation of current policies. On the other hand, there will be some volatility, but could be conducive to markets and still TBD on that side. From tech specifically, what we're seeing across the four main sectors, software, internet, fintech, and semis, is stabilization in growth. So this is looking at all of the public companies and what the NTM growth is, the next 12 months estimated growth. And what we're seeing is stabilization, again, conducive to M&A. And that's paired with an improvement in margins, also conducive to M&A. So this improvement in underpinning financials, and I see the optimism in the survey, we're seeing this certainly across the public markets as well, as growth rates stabilize and margins tend to improve. Hitting on IPOs, just to reemphasize the point, where we are at is we are in a pretty significant trough in terms of IPO activity. The markets are open, but we just haven't seen the wave of IPOs. I can say the backlog is increasing versus what we saw this time last year and the prior year, but still we haven't seen that massive wave in IPOs, meaning that we're in a state of the world where there's a significant number of private companies. The key takeaway is the green box in the bottom, where we've got 1,400 total companies. That's 35 years of IPO inventory that is presently in the ecosystem right now. And all of this wraps into this uptick in M&A that I mentioned earlier. So what we're seeing is M&A basically getting back to the 2019 levels, but also the backlog of M&A increasing as well. So we do expect a good end to the year this year, and then continued progression as we get into 2025 and beyond. Not quite back to 2021 levels, but still a great uptick. And so what we see, again, to wrap it all together, is the left-hand side, the availability of capital. It's all there. Leveraged finance markets have recovered. We are in good shape. The largest loan issuance volume since 2021. Investment grade, so for the mega tech, that's performing very well year to date. The tech titans, this is call it the big software, hardware companies, have a significant amount of cash on their balance sheet. Over 500 billion today that, but for regulators, they would be more than willing to deploy. On the right-hand side, CEO confidence is super strong. Again, the overhang is regulatory. And then in the lower right, we're seeing target prices, which the unprofitable techs tend to see, which we use as a gauge. It's declined, meaning that expectations for valuations have come down, again, conducive to M&A. So all of these factors together, we're calling it the perfect storm for M&A. And I would say, we've been in this environment for 6 months now, where we've seen strong M&A markets. So who is buying? Year to date, we've seen sponsors be the most active. Again, this is more public market focused, but sponsors being the most active in the deals that they're targeting. We've seen non-tech strategics and tech strategics accounting for that other 50 cents, with non-tech strategics edging out tech strategics by a hair, just simply due to the number that exist in the ecosystem. And then in all sectors, we see the continuation of software be the key driver of who is essentially affecting the most sales, with semiconductor and hardware really riding the AI wave and the semiconductor valuation lift coming in second, and then internet coming in third. So again, we do expect software to continue to be the lion's share of transactions, and that to persist into the medium term and the near term. One of the key themes that we're thinking that is applicable to this crowd is this uptick in private to private transactions. So we've listed a handful here. Each of these have their own idiosyncratic factors, but this is really one of the key things that we've been seeing is private companies who are either looking for an exit or private companies that are looking to partner together, and they really see that better together story, really locking arms and joining forces to, basically create a more powerful company that either has a quicker ramp to an IPO or has a more attractive profile for a potential strategic buyer. So these partnerships happening with that exit in mind. And I can, looking at this page, Cohesity, AlphaSense, Content Square, all three of these are stories where the buyer was looking to accelerate that path to an ultimate IPO. Private to private deals, they do, though, however, have some idiosyncratic challenges. The structuring can be challenging, governance challenging as well. The fiduciary responsibilities, whether you're doing a fair process and kind of getting to that outcome that a deal makes sense by scanning the ecosystem and finding out what other buyers could exist. And then the fair value as well, making sure that you're getting your shareholders the right amount of consideration, the right type of consideration, to ensure that the deal is a good one and that approval is forthcoming. And then also doing the full strategic alternative review. So looking at the standalone trajectory, the better together trajectory, or whether cashing out makes the most sense in that circumstance. So private to private deals, a big trend that we're seeing. We expect to see more. They're complicated. This is something we've been very focused on and will continue to be focused on. The other thing I alluded to was the more complex M&A strategies that we've seen. So two examples of this, and I would caveat that both are under FTC review because they are effectively synthetic mergers, is Microsoft's acquisition of Inflection AI and Amazon's acquisition of Adept AI. Both of these were on paper license and hire agreements, but effectively what happened in each situation was Microsoft, again, basically acquiring Inflection and allocating the cash to Inflection's cap table, and then hiring that team and licensing the technology. Amazon's transaction with Adept was a little bit more nuanced and involved a carve out, so Adept continues to exist on its own, but at its heart, quite similar to what Microsoft did. And this is, again, is another piece of technology in terms of deal technology that we've seen, and it is a useful tool and something that could be applicable as you look at various alternatives on the sell side upstream activity trajectory. And then the last thing to hit on is the regulatory environment. So again, I would emphasize that deals are still announcing and they're still getting done, even with what we see as a more aggressive regulatory environment. But we do have tools to help deals get done. So despite the more aggressive posture, there's longer terms in terms of ensuring that the review happens. There's regulatory break fees. There are provisions to prevent competing transactions that are all tools that can be done to enhance the likelihood that your deal can get done, whether you're on the buy side or the sell side. So wrapping it all together, our key recommendations for achieving these, achieving transformational strategic outcomes, achieving successful M&A. First, establish a clear path up front, work with your key constituents, work with your board to come up with the transaction rationale story, analyze your strategic alternatives, and how you define success. The second is priorities for your targets, priorities for your buyers. They're persistently evolving. So develop, maintain those relationships. That is critical. Third is as you're evaluating different transactions, it's all about the better together story. Specifically and more impactful in the private arena is making sure that that story is there and that it resonates, because these deals are happening. We see, similar sized private companies locking arms together. We say it is happening all around you. That is something that we're absolutely seeing. And then the last thing is just to be flexible, be adaptable. M&A is a very fluid situation. Every deal is idiosyncratic and comes with 1,000 stories. So it's something that as you go through it, be adaptable, be flexible, and persistently, soberly, and clinically do what is right for you and your company. Don't get too much deal fever. Be very focused on achieving what's best for your shareholders, your employees, your customers. So that is what I've got. I know we'll send these slides around so some of the dense data can be more easily digested, but thank you very much. And I will hand it back to you, Colin.
Awesome. Thank you so much, Dan, for that market update. Love the optimism continuing. And before we jump into our next session, I'm going to launch a quick poll to let our panelists know where you're at in terms of, are you thinking of M&A? So I'm going to launch this poll. In the next 3 months, how many of you are considering M&A as an option? Here to learn more, fully looking into it, and not ready yet. Thank you for voting. This will help our panelists dig in. All righty, let's see. Thank you for voting. I'm gonna let this roll for another second. Great. Well, looks like tons here to learn more and a bunch looking into it. So thank you for voting in that poll. And without any further delay, please join me in welcoming our panel. So we have our moderator, who's Nicola Corzine, Executive Director and CEO at the Nasdaq Entrepreneurial Center. We have Tucker Sarenbetz, who's an Advisory Managing Director at KPMG. And we have Brendan Mayer, who's a partner at Wilson Sonsini. Welcome, team.
Thank you so much, Colin. It is wonderful to be here. Tucker, Brandon, so looking forward to digging into this conversation for our early to mid-stage founders. Why don't we get started with inviting each of you to share a little bit about your background and maybe perhaps at a high level, what's drawn you into excitement for talking to our early founders today as they explore M&A activity. So Brendan, let's start with you, and then Tucker, I'll invite you to share your background too.
Sure. Thanks very much. Hi, everyone. It's a pleasure to be here. My name is Brendan Mahan. I'm a partner in the Mergers and Acquisitions group at Wilson Sonsini, which is an international law firm with its headquarters and roots in Silicon Valley. My M&A practice is pretty diverse. I have a relative equal mix between buy-side and sell-side clients, so hopefully I can give you kind of both of those perspectives here today. And while I primarily live in the middle market M&A space, I would say I do deals of all sorts of sizes, and perhaps the only part of my practice that's not so diverse, which is perhaps not surprising given our Silicon Valley roots, is that I have a lot of tech clients, although I still have a pretty diverse client base in terms of industries and sectors. So it's a pleasure to be here and looking forward to having the conversation with you all.
Thanks so much, Brendan. Tucker, welcome.
Yeah, thanks so much. So my name's Tucker Sarenbetz. I'm San Francisco based. I work for KPMG, which is a giant advisory accounting and audit firm. And personally, I support software companies. I've been doing it over 15 years on transactions through transformation, right? So all elements of due diligence, and then also supporting performance transformation post-transaction.
Excellent. Excellent. Well, Tucker, I'm going to stay with you for the first couple of minutes. We heard from Dan. We know in general, what an interesting time, what an interesting climate, a lot of optimism, 500 billion of cash sitting on the sidelines, maybe to be actioned in support of our early stage founders. So we're going to dig in. Maybe to start with that, really highlight some of this optimism out there. KPMG had recently done an incredible study and report. We're going to pop that link into the chat so that if you haven't yet read it, we'd encourage all of you joining to do that today. But it really looked at 200 large corporate and PE M&A decision makers. And it started to dig in and try to understand what is happening with these deal makers' expectations. Was there an expectation of a boost in M&A volume? And in fact, pretty much the majority came back and said, yeah, the second half of 24 and into 25 does expect a high number of deals to be happening versus, sort of waiting perhaps for the intimate future timeline that is not yet known. And most of the deal makers seem to report back an elevated realization that even with interest rates increasing and mismatched buyer-seller valuation expectations, they still were optimistic and hopeful that the deals were going to unfold and that those wouldn't be the main factors that held them back. So Tucker, let's start with all of that good intelligence guiding us. Are you actually finding that to be true right now in your practice? Maybe could you dive into a little bit more about what you're seeing this quarter and maybe ask you to sort of peel into the crystal ball and figure out what you might be thinking of for next quarter as well?
Yeah. Thanks so much, Nicola. So that is, exactly what we're seeing, right? Deals are still getting done, but the majority of deal makers still see those two, meaningful barriers you called out, right, around the valuations and the interest rates. That said, many of the respondents to our survey said that a pretty kind of modest, further decline in interest rates, 25 to 50 basis points, could really drive activity, quite a bit higher.
Mm.
And many of them were planning to do kind of more deals in Q3 and Q4 than they did in the same time period in 23. And then again, looking to do even more deals in 25 and 24. And the increased interest was most pronounced actually among PE buyers.
Mm.
So, I think as we look, into the next quarter, the end of this year, and then into 25, our expectation, and of course there are a lot of error bars around it, but our expectation is the deal volume should continue to increase.
Well, that is great, and I think certainly, for our founders as they start to plan out with intentionality around how do we get there, having that sort of mindset of 6 to 9 months, it's going to be a good window for them to explore. That's great. I think obviously the other thematic that probably everyone here is aware of and excited to dig into a little bit and hear your guidance on, Tucker, is of course Gen AI. I think in the same study, there was recognition that about 80% of deal makers said that it's had some impact, a material impact on their deals, and almost half saying that their strategy now involves buying Gen AI tech or products. Let's break that down a little bit, because I think there's so much still uncertainty around what do we talk about when it comes to Gen AI? What does that mean from a valuation perspective? So what would you guide early to mid-stage companies to really be thinking about as it relates to generative AI right now in exploring an M&A strategy?
Yeah, so I think, first, Nicola, you called out that kind of 80%, right? It's changing how they think about deals. And that 80%, it's really kind of broken into two buckets, right? So we saw about 40% or half of that 80%, we're really all in how they're using Gen AI to accelerate their deal process. And, probably less relevant for this audience, but, could talk about that, if we wanted to. And then the other 40% we're really thinking about, how they, want to acquire more kind of like product and technology, to accelerate that. So then for an early to mid-stage founder, kind of like what are the expectations? So, I would say that buyers, want to see perspective on how Gen AI is influencing, your product and delivery model. And they're going to want to see some progress in thinking on that. I think they're also going to want to see, to the extent there's commercial pressure from Gen AI, right, that your monetization model needs to change to reflect that. They're also going to want to see companies making steps, to get in front of that. I think where there's less of an expectation that entrepreneurs invest is really in kind of taking cost out with Gen AI, because a lot of these buyers will have existing playbooks or perspectives on that. And frankly, they view that as kind of less mission critical than getting it built into the product and delivery model and making sure the commercial model is kind of fit for the Gen AI future. So I think that's what our kind of suggestion would be for those mid to early stage entrepreneurs.
Very, very helpful. And I think especially insightful around the pricing model considerations for many of our founders who are still, quite honestly, probably figuring out the ultimate pricing strategy for themselves. Okay, Brandon, let's talk about the other elephant in the room, if it's not about the political moment that is on the imminent horizon, the regulatory one. And certainly, as we heard from Dan, the thing that is holding back all that cash on the balance sheet largely is around regulation. So, as we look at the study that KPMG did and others, antitrust regulation is clearly a much, much bigger issue for private equity than corporate. What do you think smaller companies need to be thinking about in terms of regulation right now and its effects, its material effects potentially on them? And I guess a secondary question, if we can, is there a lot of variance that you're seeing by industry? We would presume so. And where do you see the deals actually getting stalled when it comes to a regulatory consideration?
Yeah, no, that's a great question. No, it's a great question. And I think I would endorse the summary from Dan, which is that although it's a very challenging regulatory environment, deals are still getting done. I think with respect to antitrust, it's interesting in that the Biden administration has definitely shifted the way the at least U.S. antitrust merger enforcement landscape has been working over the past few years. It'll be interesting to see what comes in the upcoming election, because I think the expectation is, regardless of who wins, when you have a change of president, even if it's a change within the same party, you're probably going to get a change in the guard in the heads of the regulatory agencies. So we may get a shift in tone regardless of who wins the presidential election in a few months. But I think what we've seen over the past few years is definitely many high-profile merger challenges, many of which have been in the tech sector, which have been aimed at reversing what the agencies believe has been an over-consolidation in certain markets, including the tech sector, and generally just more active enforcement and aggressiveness. One interesting element is that although in some cases the agencies have suffered defeats in court, they're kind of nevertheless emboldened and seem to tout the fact that that they're putting up the fight seems to have many transactions that they view as anti-competitive being abandoned in the face of their increased scrutiny, which I think is certainly true. I think what it means for companies and the entrepreneurs here is that it's really important to plan ahead and reach out to your counsel at the outset and think about antitrust risk early in the process so we can help you think about that and manage that. And particularly with respect to your expectations about overall timeline for the transactions. If you're in an extended review period, that may have a very different, benefit risk analysis in just terms of whether or not the deal makes sense and who your potential buyers are going to be if you're on the sell side. And I think you shouldn't also assume just if you're a smaller company that you're necessarily exempt from these things. I think first I'd say just at least in the United States, our Antitrust Act, the HSR Act, currently has a filing threshold of $119 million. And I'm slightly oversimplifying that because there's both a size of transaction test, which is the $119 million, and a size of person test. But generally speaking, I mean, I don't think that's a very large transaction. You can regularly find yourself, with a filing obligation with deals just over $100 million. And moreover, for smaller companies, the DOJ and the FTC have said that if you have a market share of over 30%, that can be presumed to be illegal, and that doesn't matter if the counterparty to the transaction has relatively minimal market share. So I think overall what I would say is you shouldn't assume that just if you're a smaller company, you can kind of fly under the radar. That's certainly not the case. The agencies are emboldened and more aggressive recently than they have been in the past years. But I don't want to sound like I'm too much of a pessimist because, as I said at the outset, I do fully endorse what Dan said at the beginning, that it's a more challenging environment than it has been, if you go several years back. But nevertheless, deals are happening. So I think it's just a matter of setting expectations about what the risk profile is and what the likely timeline to actually close a deal will be in the face of antitrust scrutiny.
Yeah, no, so insightful. And I think, we at the center have seen on a number of occasions that timeline has really expanded potentially in a number of deals, and managing cash flow expectations and sort of just staying the course psychologically during that timeline is equally critical for founders involved. So
yeah, absolutely. And if you're a seller in a transaction, right? I mean, one thing you always have to worry about is what restrictions are going to be imposed on you between the time of signing and closing the deal, and that can be a very different thing if you're thinking it's going to be a 2-month horizon versus a year or more, and just how do you manage your business in that can be challenging.
Yeah, that's the reason to always have smart, incredible industry leaders like yourselves reflected here around you on that table, and definitely to lean into that advisory support as needed from others who have gone through that type of scenario too. Okay, so we've already talked about politics on a number of fronts. I want to stay with that for a minute because obviously it is the obvious question and uncertainty, I think, for many of our founders that are considering M&A during this moment in time. With all that is unfolding, with even hearing from that same study how much deal makers are looking at geopolitics right now and having an effect on their deal making, and the uncertainty of sort of this market climate at large. What do each of you, and Brandon, maybe I'll start with you, from a founder perspective, think that they need to be dealing with right now to position themselves well for deal making with all that uncertainty that's surrounding them? I mean, how do you sort of deal with the unknowns and at the same time try to be predictive and strategic in getting your company sold, getting ready for this big transaction on the horizon?
Yeah, I mean, it's a great question. So, I mean, I think one thing which I think I think was alluded to earlier in this panel is that alongside pure M&A, I think we're also seeing a rebound in other commercial collaborative arrangements, joint ventures, minority investment activity, and that sort of thing that don't always get captured by pure M&A league tables if you're just looking at how well M&A is doing. in some cases, I do suspect that may be driven by, a desire for perhaps would-be buyers to participate in new markets or to collaborate with smaller companies without committing themselves to buying companies, or to perhaps go into geopolitical reasons that may be disadvantageous for various reasons. So I would say, I think for sellers, I mean, if you're encountering counterparties that seem uncertain in doing a pure M&A deal for various reasons because they're unsure about what the future holds, I think you should just strongly consider, whether other commercial partnerships short of a full M&A transaction may be a viable alternative and may meet your needs as well. I think buyers are always cognizant of geopolitical factors just in terms of their long-term planning, so that's always going to be on the front of their mind. I mean, I would also say, just with the upcoming election, and I think the data bears this out, that generally elections do cause a general slowdown or reluctance to do M&A. And I think that's just because uncertainty is something that scares people and makes them hold on to their wallets a little bit more. So deals are certainly happening, and I think they're going to continue to happen. But I think depending on how uncertain the election results are going to be, I think we may see some people hold off in doing transactions until after the elections.
Yeah, I was going to ask you that, not to again force the crystal ball on your side right now, Brandon, but in your perspective, when you've looked at historical outcomes, is there typically a quick rebound opportunity? So once it's known, does activity start unfolding relatively quickly, or is there still sort of a couple of quarters of waking up before the deals really get done?
I think maybe there's a few quarters of waking up. I guess we'll see who wins the election. I think that's going to depend on a large part about whether or not there's going to be a large shift in policy, at least in the United States. But I think you may see a lag just in terms of seeing what the future is going to hold. But I think we probably have a relatively good idea about what either future administration will look like. So hopefully it's not going to be a long time for the market to react to that.
Excellent. Tucker, let's turn to you. From your perspective, obviously a ton of founders trust and learn, and you're advising on both sides. What would you suggest and advise founders to be thinking of right now as it relates to this current market and this current moment and the unknowns of the political landscape? What would you say from a strategic position founders could be doing to stay the course and really position themselves well to take advantage whenever the lag is catching up and the opportunities present themselves?
Yeah, thanks, Nicola. It's a good topic, and maybe just to add one thing to what Brendan said, and you'll see this in the survey results we published too. But right now, more deal makers are seeing the geopolitical situation as an accelerator, right, rather than something that's delaying deals. Particularly as we're seeing potentially more stability. In places like Gaza and Ukraine, and with the upcoming election, bringing some stability as well. So I would, advise people to think about, okay, how can geopolitics actually help me, right? How can it accelerate my process? Or kind of given, for example, the end markets I have access to, right? Can, some of this geopolitical uncertainty actually be kind of an asset for me? So I would just say, I'll always be kind of looking at both sides of that question, right? Can it be an asset or an accelerator?
We love it when we can find that acceleration, for sure, especially for our founders. Okay, so we always talk, I shouldn't say always talk, there has been a lot of talk and a lot of sort of expected understanding as to, okay, IPO slowdown, M&A pickup. But I think for a lot of first-time founders, of which the center has a wide majority on its base, there's sort of a little bit of uncertainty as to, okay, if less IPOs and more acquisitions, how do we take into account what is going on at the market dynamic level that's really providing for these type of circumstances? So for both of you, I'd love us to maybe go back to basics just a little bit and help us all understand, maybe with a little bit more clarity today, how the IPO market and the M&A market work together, or don't, as the case might be, when it comes to these moments where we're trying to read tea leaves a little bit and figure out what's going up and what the timing means with a transaction sensitivity to our founders. Tucker, can I start with you? And then Brandon would just love you to sort of share your perspectives on that too.
Yeah, absolutely, Nicole, and thanks for bringing up the topic. It's a good topic, and clearly, how if you're in a place where you're ready to sell, right, it influences how you want to be thinking about your business and operating your business. For an IPO, there's less relevance to this, but when you're looking at a deal, you need to think about, okay, what are those M&A product kind of end market vectors, right, that are going to be interesting, for an acquirer, right, and make sure you're building, a business that can, effectively, lean into that ecosystem, right, and be an important part of an ecosystem. I think interestingly, in the next year, deal makers were kind of most excited about kind of transformational deals, right, and also tuck-ins, right? So thinking about, okay, yeah, how could my business, be bolted on? What sort of enterprise am I a reasonable extension for? And then, hey, if someone was to acquire me, right, how could I be kind of more transformational for their business, right? So thinking about, okay, even if I'm, a relatively small company, I'm looking at being acquired by a larger set of players, right? How can I really position, what I bring to the table as something that can be, transformational for that enterprise? So those are a couple of the considerations that may be different in this moment, where there's a little bit less IPO activity.
Excellent. Love the transformational and tuck-in. I think that the perspective of helping people sort of figure out what camp they might be in and then ultimately build a potential list of acquirers that would make the most sense for them based on where their stage is too. Very helpful. Thank you. Brandon, anything you'd add to that equation?
Yeah, I think that was well said by Tucker. And I mean, although I think running an M&A sell side process or running an IPO, either of those can be full-time jobs, but many companies do them at the same time, right? So dual track acquisitions happen quite regularly. So people think of those as alternatives in that way. And I think just a lot of the same considerations do flow into each of them. I mean, I think building your professional deal team is important, getting investment bankers on your side, getting your attorneys on your side, hiring your accountants, and getting everyone in a row. And I think just preparing for either can be a fairly similar work stream. And I think just getting your house in order, being organized, organized companies, denote strong businesses and talented management teams, which can support higher valuations and successful exits as well. So I think there's a lot of the same work that can go into either, and there's nothing that prevents you from doing both at the same time if the IPO markets and M&A markets cooperate, other than the fact that you also have a company to run and you can't be three places at once.
Would you get? Well, you said some magic words there. You said high evaluation, successful exits, obviously the nature that's drawn everyone here today. I want to stay with just the sage advice that each of you have had from so many successful transactions that you've seen over time, and really dig into like, what are some of those golden nuggets, those recommendations that you'd have for helping to evaluate M&A opportunities for early to mid-stage companies? What are the signals that they need to be watching out for? And what are the indicators that they need to be really ready to share and able to be, on paper, on the record, as they go through this process? So Brendan, let's start with you from the legal side. As you're advising these founders in the early days of the transaction and as the transaction progresses, what are some of the tips and tricks that you would really say to them, be ready for this as you go into this evaluation period?
Yeah, I think it's really important to run a good disciplined process. So I think process really does matter for M&A transactions. And so I think for sellers, that means exploring alternatives other to M&A, frankly. But I think when you're exploring M&A, that means keeping your board and your key investors apprised of exactly what you're doing, who you're talking to from the outset. For buyers, I think that just means running a disciplined process, backed up by your financial and strategic rationale for the deal and making sure that the business case is being furthered by what you're doing. I think that's really important because one way deals can often go astray is if there's some must-haves that some key constituents you have, whether that's your founder group or your investors, that you're not raising at the outset, and you think you have an agreement on terms, but you've kind of delayed the negotiation of those must-haves until later. And so I think just keeping that in mind and being forthright about what is critical to you in order to be able to successfully execute, and just keeping all of your constituents in the loop to make sure that everyone's on the same page on your side of the table.
That's great.
I would also say that just keep in mind, which is kind of goes back to one of the first questions about antitrust, that the M&A process can take a really long time, and that can be the case even without antitrust review. So I think you should just be prepared when making your evaluation with respect to what you're going to do, that this isn't something that's likely to happen immediately, and this is something that can take months, and you should plan accordingly.
Excellent sage advice. Thank you, Brandon. Tucker, from your side, on the advisory side, what are some of the tips, tricks, recommendations that you'd have?
Yeah, I mean, I think everything Brendan said really, really resonates. Maybe just a couple things to add. So, getting kind of the sell side kind of data packs and data hygiene in order, can also be, really important, right? It's something that can definitely kind of kill a deal, right? If there are questions about the numbers. And then also walking this kind of fine line between being transparent and open and kind of good to work with, right, for the buyer. But, right, not, providing, things which could, delay the deal, or, create, questions that, may not be all that relevant. It's always a very kind of like challenging line to walk for acquired companies, and something that we see a lot of, sellers struggle with. There was a deal I was working on earlier this year, and basically the perception that the target company was challenging to work with in the diligence context was a major factor, right? That ultimately killed the deal. So I think making sure, like, okay, you're transparent, you're open, you have your data in kind of good situation, but you're still kind of like managing your requests, right, of the buyer appropriately. Getting that right can be super important.
Yeah, really, really thoughtful. One of the really exciting upcoming conversations right after this panel is going to be around culture. And really, I think, for every team that is considering acquisition, for the most part, there is going to be an expectation of hopefully finding a really good fit. It starts from before the deal obviously has been happening, including sort of that open communications, that responsiveness, the way in which you're really getting to know each other, even in that early diligence phase. So Tucker, thanks for reminding us of that. That assessment, that evaluation is really starting from minute 1, hour 1, day 1. So thanks for that. I'm going to do another round robin of questions, but before I do, this is my PSA to everyone joining. We're going to be opening up here for a live Q&A in just a few minutes. So if you have questions for Tucker and Brandon that you'd like us to get to, please go ahead and pop those into that Q&A function, and we'll try to get to just as many as we can. Okay, guys, back to you just for a second. Obviously, as many successes and rainbows and unicorns and happy outcomes as I'd love to stay there, I'm definitely a glass half full kind of gal. There are moments, obviously, when we all know that the deal has gotten stalled or the deal has gone away. Probably more often than not, it's the right outcome that happened. But for many founders, where this is the first time that they're going through a transaction or preparing themselves to go through a transaction, there is an uncertainty as to like what actually causes that to occur. What usually are the reasons that a deal will get stalled? I'd love to invite you to sort of dig back into that treasure trove of knowledge and expertise from both of your perspectives, and share maybe a few examples that you've seen anecdotally around what can cause a deal to go off track, and hopefully with that same encouragement to our founders to not get themselves stuck in that position if possible. So Tucker, maybe I'll start with you, and then Brendan would love your thoughts too.
Yeah, so I mean, it's a really good question, Nicola, and it's really interesting topic. It's almost like the kind of Anna Karenina quote, right, where there are many things that can cause a deal to go awry, but kind of to get it to go well, most things have to go right. So we see, valuation, as we talked about before, kind of culture fit. I mean, recently, in particular, I think shifting, valuations, right, from the time an LOI, for instance, is signed, can be a major factor. We see, commercial diligence, tax diligence, sometimes a product or technology diligence where the product stack or product fit is not what people thought at the onset of the deal, creating an issue. Frequently, the whole kind of box of kind of legal things can definitely, independently, slow or stall a deal, including antitrust. So yeah, I mean, there are kind of many more ways it can go wrong than go right, I guess.
So be prepared, I guess, and
Yeah.
sort of take it one day at a time a little bit there, right? Yeah, very good. Very, very good. All right, Brendan, what about you? Got any tips, insights for us on deals that may have been expected to hopefully have closed and then just didn't?
Yeah, I mirror what Tucker said. I mean, I think there's lots of different ways deals can go off the rails. I mean, I think probably on the substance, I think the most notable evolution that I've seen in the past few years is the valuation gap between buyers and sellers has been wider than it has been recently. I think I am an optimist in that respect about more deals getting done in spite of that, because I think that is lessening now. Now that the S&P is having multiples that are more in line with what sellers will often expect. But I think to get deals done, you sometimes need to put on your creative hat. I think with respect to valuations, we're seeing an increase in earnout activity still, just as a way to bridge those gaps. And I think just kind of being flexible and creative in the process of negotiations is always important. And frankly, one of the things that I love about mergers and acquisitions, because you can do a lot of bespoke things that you may not be able to do in sort of other legal environments. And I think, to mirror one of the things that Tucker said, I think due diligence from buyers is a theme that we're seeing is being increasingly important to buyers. They're being much more disciplined about that. And I think one thing just to keep in mind is that, this is usually a marathon, not a sprint. And so I think deal fatigue can often get the better of people when you're being peppered with a panoply of questions from the buyer in the due diligence process, and just kind of taking a step back and realizing that there is an end in sight and successful exit in sight, and it's a marathon, not a sprint. But I am an optimist in terms of the current market, so I think we're going to be continuing to see a greater success in deals moving from the LOI stage to the signed and closed stage.
Excellent. Excellent to hear that. And the earnout insight is really insightful too. I think over the last couple of years, it certainly seems that that's progressing. Maybe to just put you on the spot for a minute, go a bit off script. For a lot of our founders, again, where this is the first time they're negotiating and navigating, the prevailing mythology a bit in Silicon Valley is often that earnouts work against founders simply because the power dynamics are not in their favor. So there's so many things that they can't control, prioritization, marketing, budget spend, et cetera, around really getting that earnout. Do you have any guidance that you often encourage founders to think through when they get into those earnout conversations, where obviously they're looking and hoping for the big payday, but there's so much uncertainty and so many of the things that are outside of their control to be able to ensure that happens when you're looking many years out with a very large corporation that's really holding a lot of those cards to themselves?
Yeah, no, it's a great point. I mean, I wouldn't say that earnouts are the first place I'd pivot to. But if you really do have a valuation gap that can't otherwise be can be solved, I think that's an option available to you. But you're absolutely right. I mean, they can be incredibly challenging themselves, and it raises the host of questions that you're raising of who controls the company, what rights does the founding team have to actually ensure that there's going to be efforts to achieve the earnout. So I certainly wouldn't pivot to an earnout in the first instance, because you're going to be then negotiating rather than the price itself. You may agree on what the spread is with respect to the earnout, but then you're negotiating what are the buyer's obligations, what are our rights, who actually controls the business, and it kind of opens up another can of worms. So there certainly are challenges to earnouts. I wouldn't say it's a one size fit all or the thing that you should jump to first, but if you truly are having a valuation gap, I think it's an avenue worth exploring.
Absolutely. And again, I think Brandon comes back to the very important point of making sure that you have a great team around you, right? So if and when you do start entering into secondary negotiations around those types of touch points and critical factors, then you've got the right people that are really advocating and looking at the paperwork to see how best they can support you in making sure that things are going in your direction as much as possible too. All right, so I've got one last question, and then we're going to go to some really good Q&A that's been coming in from our attendees today. Thank you all so much for contributing to that, and for the ones that were submitted earlier too. We'll try to cover as many as we can. M&A this year, if you had to give a couple of suggestions on factors to inform an outlook for early to mid-stage founders, What do you use? What resources, what tools, what tips, what tricks are you looking at right now to really guide on M&A market activity, and what signals you're looking at as to what is really changing or what's shifting right now? So factors informing outlook. Where do you turn, Brandon? What's your trusted sources? What would you suggest our founders look for right now, or read, or learn about more?
Yeah, I mean, I think there's a lot of good literature out there, obviously, including what Dan shared and what Tucker shared in terms of what's out there in the market. I mean, I would say, I think it's important to keep a long-term perspective on things, because although, the M&A market has slowed over the past few years just compared to long-term trends, I'm not going to discount that. I think people are also, have the kind of more immediate memory of what happened in 2021, which was the highest M&A activity ever on record. So when people say, the M&A markets aren't as hot as they were 3 years ago, you're really saying it's not the all-time record high right now. So I'm not discounting that the M&A market is down, but I think it's just important to keep that historical perspective there's ebbs and flows, and we certainly aren't at an all-time low right now. I think ultimately how I'm going to at least personally assess the rebound in the market is, I heard one of my colleagues say recently, somewhat affectionately, that her email inbox looked like a letter of intent graveyard, because it seems like there's a robust interest in M&A, but it's difficult to move from an LOI to a signed deal. And I'm definitely seeing personally that's improving. And so I think what I'm going to be personally looking for is kind of how many of those deals that seem to have acute interest in them move out of it, or are able to avoid the graveyard and can move into signed deals. And I'm certainly an optimist, because I'm seeing a lot more success moving deals from the LOI stage to the signed agreement stage. Mm-hmm. And I think I think acquisitions just generally just remain an important way for companies to gain technology they think is important, to gain talent they think is important, and capabilities that they may not have. And I think the technology sector in particular is really robust right now. So I think there's still a lot of sentiment that buy over build is a path to success. And I think although the market, the M&A market is certainly down compared to historical long-term averages, I am an optimist that things will improve over the remainder of this year and next year.
We're glad you're an optimist, and here's to avoiding the LOI graveyard for sure, Brenda. Let's hopefully move away from that one. Tucker, over to you. What are some of the signals? Where are some of the places? What are you looking for right now as indications of a healthier time to come?
Yeah. I mean, I think like every, market and segment and company is so different. I think the advice to founders or owners would be to kind of run your own race, right? With respect to M&A. Keep tabs, on what your competitors, the other players in your market are doing. Talk to folks in your market, talk to your trusted advisors, right? They're the ones that are really going to kind of understand, the kind of relevance for what's happening in the market for you and your company and your industry, right? Because that's what's going to have a lot more relevance than kind of broad kind of M&A kind of deal making volume. So I guess that would be my kind of specific recommendation. For me, personally, it's going to be, seeing what, our comparator firms, our teams are kind of doing in terms of early volume. We keep track of that regularly. So that's what I'll be looking to. But again, that's the volume that has relevance for our business, right? So that's our own method.
Yeah. Very fair. Very fair. Okay, well, we're going to try to get to as many questions as we can. I'm just going to invite whoever has a thought to sort of chime into these. Let's start with a really interesting question around IP-based acquisitions. Okay, obviously, once upon a time they were very high, very dominant in market. And they take out things like, I don't know, the revenue generating question and the modeling and all types of things. What are you seeing right now as far as transactions go relative to IP deals? And then I'm equally going to add in on this, because it's obviously something that happened dominantly in the 2009 market around sort of talent acquisitions. Are you seeing those pop up, especially relative to maybe some of the Gen AI situations? Are talent acquisitions popping back up. So IP acquisitions, talent acquisitions. Any insights on both of those sides right now?
I'm happy to go first. I mean, so I think those are both very robust right now, and I think particularly in the Gen AI space, we are seeing a lot of companies seeking to purchase companies essentially on an acqui-hire basis. I mean, so I think AI engineers are certainly a hot commodity now, and a lot of the impetus for buying a company with a heavy and robust AI focus is going to be the talent. So I think that is definitely something that we're seeing. And I think if you had to pinpoint kind of two areas where I think the M&A market is probably the most robust, I think it's probably in those two areas. It's IP buys and companies looking to acquire talent.
Excellent. So maybe some faster speed to outcome and moving beyond LOI there. Very good. Very good. Anything to add?
No, I would say anecdotally what Brendan said makes a lot of sense. I'd say we're seeing a bit of that too. Thanks, Nicola.
Yeah, absolutely. Okay, so from no revenue, we had another one coming in. This seems to be from a Series B company. Obviously, Series B is an interesting stage in and of itself, but this particular founder reflected they've got about 150 million annually right now in revenue. What are you seeing sort of around that type of, maybe I wouldn't call them so early stage as far as what some of our founders may be joining us today, but at that stage, is there anything perspective-wise that you'd offer to startups who have got some predictable, certainly growing revenue and have closed through sort of a Series B inflection point?
Yeah, I mean, I think it's going to be very kind of like subsector or sector, subsector relevance, right? But assuming this is a technology company, maybe a software company, you really need to start thinking about the secondary metrics that are going to be top of mind to acquirers, and how you kind of drive those right in advance of a discussion, right? So what are your kind of retention rates? What is your CLV to CAC ratios? How else can you kind of make sure you're developing kind of a healthy business as you pivot to broader set of metrics that are not just revenues.
Excellent. Excellent. Let's stay there just for a second, because we've had a lot of questions that came in early, and then again, a couple live right now, trying to get maybe a little bit more granularity around the KPIs. You gave us just a couple, Tucker, and again, I fully appreciate that it's very industry specific. But how do you help generally founders think about, am I at a right stage? What are the indicators I should be looking at to know whether or not I should be pursuing acquisition at this time? Are there some broad stroke generalities you'd offer?
Yeah, I mean, I think you hit the nail on the head, Nicola. Very broadly, it depends, right? And companies get acquired at kind of all stages of the life cycle, right? And at all, kind of revenue thresholds. So I would say look at your strategy, right? How are you looking to get acquired, and then kind of given that, you can understand, okay, what are the key metrics that folks are looking at, whether it's a revenue metric, an ARR, and a recurring revenue metric, a profitability metric, and design to the sweet spot of your thesis, right? Your sell side thesis.
Yeah, love that. Okay. Had a great question come in from an attendee at Johnson. Thank you for this. We've spoken kind of at a broad brushstroke level on having the right team around you. I'd like to know, what are the in-house positions perhaps, and what are the out-house positions that one should be looking at for the right deal team to really come together, and especially maybe taking in account companies that are under 250 million in revenue. So how do you get sort of the right balance of in-house resources versus outside help, and who should be on kind of your core deal team, if you will, as you're going through this acquisition strategy?
Yeah, I think it's an excellent question. I mean, there's certainly no one size fits all. I mean, I think what we commonly find particularly with respect to early stage companies and early stage entrepreneurs, is that they may not have yet built out, a very robust in-house legal function or in-house financial function. And so I think, heavily relying on the advisors is much more common for those early stage companies who kind of don't have those resources. And I think it's also important to keep in mind that doing an M&A transaction can in many respects be like a second job. And so you have your day job to run too, and you need to keep running your business and keep looking towards success. And so I think what I find in early to mid stage companies is that they often heavily rely on the outside advisors just because they have a business to run and they don't have time to take on the second job. And so I do think that there tends to be a decent amount of outsourcing work to both law firms, accountants, and bankers just as a matter of managing time. And particularly when you're negotiating a deal, you don't know that necessarily that deal is going to end up signing or closing, and you still have a business to run. And so I think managing those two things can be very difficult, and that's frankly why people like Tucker and I are here to help.
It's good to have people there to help, for sure. Interesting question that came in about sort of the movement or maybe the interesting dynamic with family offices that are suddenly showing up, really supporting a lot of credit and equity in M&A deals and in the M&A market at large. Do you think that they're a valuable resource for buyers to seek capital from? Are you noticing any sort of shifts perhaps in perspectives as they've entered into this side of support in M&A at large?
Yeah, I mean, I'd be interested what Brendan and you are seeing, Nicola. It's not an area where I've personally spent that much time.
Brendan, anything you've noticed on that side?
Yeah, I must confess the same is for me. I don't have a very robust data set on that one. I must confess.
That's fair. Let's say that we're going to keep watching it and see if we can report back on it in a more comprehensive way, perhaps in the next M&A update that we do. We've anecdotally heard the same, but again, certainly the sample size is relatively small and not of a quant level that I think we would be smart enough to have an informed opinion of, or just even know what it means for our founders. Obviously, anytime new entrants enter a market is just always an interesting time to understand what's encouraging them to sort of show up in the space, what is motivating them. We can say sort of from additional work that we've done around the Venture Equity Project, which is now a 3-year research initiative led by the center. One of the things that has come up around family offices is an important when you've had generational change in leadership there and sort of their ability to take a step back and align sort of their values and priorities of new layer as to what they want to be investing in. So I think to any founder that is considering just a deeper exploration of capital from family offices in any regard, just understanding sort of their motivational and priorities to the extent that you can is always good. Obviously, it's a hard market to get to know for obvious reasons, but to the extent that you're interested in exploring that would be one thing that dominantly shows up, is just looking at sort of the values and priorities of that family office and realizing that they have their own strategy that's really guiding and making recommendations as to where they invest and what's driving them to make investments in a new sector or a new space. Valuation gaps. Obviously, not surprisingly, a lot of people were really curious and really interested to hear some of those perspectives and insights that both of you have shared around that, and especially Brendan from you. As you look sort of over this timeline of maybe 2021, 2022, what do you think is on the mind of sellers as it relates to valuation gaps and where they're sort of like willing to move and not willing to move when it comes to valuations? What's driving informed decisions around valuation gaps? Maybe I'll put it that way.
Yeah, I think it's an excellent question. I mean, so I think there's a perspective of kind of what the historical valuations multiples have been for companies, which is something that is maybe rebounding now compared to the lows we've seen recently. I think it's also important to understand your investor base and where each investor may have invested in, because if you have an investor that invested in 2021 when valuation multiples were very high, they may have a very different perspective on what their successful exit looks like than you as a founder or someone who invested perhaps earlier. And so I think just having a frank conversation with your key investors about what actually a successful exit for them will look like is important. I mean, I do think that with the increasing multiples that we're seeing recently in S&P 500, I do have some optimism that those valuation gaps are going to be shrinking, but it still certainly is something that we're seeing being a key obstacle in early stage M&A negotiations.
Very fair. Good question that's come in. We always like to say at the center, due diligence is a two-way street, meaning that we want our founders to be informed. We want them to be making the best choices that work for them in all sides, as I know each of you hold that with your firm's perspective too. So how do you help founders think through, like, how do I evaluate if this is a good firm, whether it's a law firm, an advisory firm, a bank, that can really help them navigate potential acquisition? Like, what are some of the questions or what are some of the strategies that you've seen to really help illuminate good fit for founders when it comes to finding trusted sources to work with?
Yeah, I mean, I think you want to take, a holistic. So if you're looking at an acquisition, right, there are a number of different, pieces of the business I think you kind of need to look at and evaluate independently. I think it's fantastic you're having, discussion around culture and kind of HR, but, on the same side, like understanding the technology stack, like broad brushstrokes, right? And if that's a good, fit for you is important, right? Understanding operationally, right, how the businesses are likely to come together, right? And what it might look like 6, 9, 12 months down the line, right? That's really important. Understanding the customer set, right? And how your customers and the customers from the acquiring business, right, stack up, right? Same customers, same segments, different segments. How your sales forces will come together, right? At the level of kind of every function. I think it's important to really kind of understand, what this will look like, as a single entity instead of two entities. And I think, gaining some kind of comfort on what the decisions are likely to be there, what the subsequent integration will look like, will really help generate a lot of, confidence and also kind of understanding of what, what's going to be on the roadmap, right, as the businesses come together.
Yeah, it's a great approach to looking at the holistic implications of really getting these two companies together and realizing that there isn't one part of it that's not going to be impacted as you look at all those considerations and explore potential fit. Thank you. A couple of people were really interested in learning a little bit more about some of the other commercial alternatives that we gave a mic drop moment to a little earlier in the conversation, be they JVs, joint ventures, or some of the other considerations. And equally, there was a question around reverse mergers. I guess I'll pose it to both of you on this front. What are some of the other commercial alternatives that you're seeing emerge right now, other than just a straight out acquisition? And can you give a couple of examples that you've seen that have worked well in those areas?
So maybe I'll start. So I think collaborations and partnerships and joint ventures, and I use joint ventures maybe more colloquially because I think we normally counsel our clients that commercial contracts and partnerships are much easier and much more likely to be successful than true joint ventures where you each own 50-50 or some other percentage in an actual entity. So I think those are certainly alternatives to a true M&A deal, coupled with perhaps strategic investments. I mean, these things come in all sizes and flavors, so it's a bit hard to give kind of one answer that kind of fits everything. I think reverse mergers are interesting, which I think was the second part of your question, Nicola. I assume by that we refer to a public company that may have little or nominal operations that's merging with a private company as a way for that private company to go public. I think we're certainly still seeing a lot of those as an alternative to doing a traditional IPO. I think there's reasons to be a bit skeptical of those in some sense, because I mean, I think the part of the difficulty in that beyond doing a traditional IPO is you're actually merging with another entity, and so you're inheriting all the historical liabilities associated with that, and have to think about whether or not that really makes sense. But that certainly is something that we're seeing. We've seen previously were continuing to see as an alternative to IPOs. And I think it's something that people should certainly be willing to explore with, I think, maybe I may say a slightly cautious eye.
We'll take cautious eyes, but we'll also appreciate the fact that greater optionality is always a benefit to our founders. So finding the right
Absolutely.
fit, the right stage and the right deal is always a good thing. Thanks for that guidance. And speaking of guidance, it is hard to believe, but we have had coming to the end of our time together with these incredible leaders. Brandon, Tucker, thank you so much. Before I let you go, though, we have one rule at the center, and that is, could you give us just one more tidbit? Could you give us just one key takeaway? So I'm going to put you both on the spot before saying a final thank you. Tucker, maybe I'll start with you, and then Brandon, invite you to sort of round us out. What's one last takeaway that you'd really encourage our early to mid-stage founders joining, those listening and watching afterwards, to be able to inform their thoughts as it relates to this market, this moment, and M&A activity?
Yeah, I don't know. Maybe just one thing is, as you think about going to market with your business, or if you're making an acquisition, just being kind of like a good student of the business is important. I mean, I think you would be surprised, or maybe not, how many kind of executives, right, can't answer, questions about, their customers, right, their sales methodology, like relatively kind of simple things, about their business. So I think just kind of like making sure you kind of really understand the ins and outs, that you have a perspective on, what a buyer is going to be looking at and asking about, and building your own perspective on that is really important. So I think that might be my parting words.
Good parting words, and we can promise I'm going to put all of our founders joining on the hook to say they're going to know their business, they're going to be ready, they're going to be prepared, they're going to be thoughtful, and they're going to be armed with all these great insights today. Tucker, thank you so much. Brendan, over to you. Final thoughts, final takeaway for today.
Yeah, I would say just keep running your business. I mean, you've been successful, so continue to drive towards success and more success. And I think buyers want to buy successful companies, and so I think you don't want to seem too desperate that you're on the chopping block. And I think the deals will come to you if you just continue to keep running a successful business.
So good. Success begets success. We love that. Guys, thank you so much. It has been an absolute joy learning and listening to you both today. I know our founders have really appreciated it, and will be downloading that report if they haven't already done it. So thank you for that. Cullen, back to you.
Oh, thank you so much, Nicola, Brendan, and Tucker. What a masterclass in early to mid-stage M&A strategy. Thank you so much for joining us, fellas.
Of course.
Okay. Up next, we're going to take a quick break. But before we do that, I'm going to give you all the opportunity to express interest if you want to follow up with any of our partners over at Wilson KPMG. We'll make sure that we get you in touch with them. So we're going to take a quick 5-minute break and then continue our bootcamp today with a fireside chat with Sammy Kaipa, and then our final panel on growth through acquisition. So we're going to take a quick 5-minute break, and we will see you soon. Welcome back. So up next, please welcome me, and joining our next special guests, we have Sammy Kaipa, who's co-founder of Tingono, and John Throat, who's a vice president, head of America's People Planning and Partnerships at Nasdaq. Sammy, John, welcome.
Hey there, Colin. Thanks for having us.
So excited.
Hey, thanks for having us, Colin.
Over to you.
Great. Wonderful. Welcome, Sammy.
Thanks for having me, John.
Yeah, great. So looking forward to our fireside chat here. Sammy, maybe just to kick things off, maybe do a quick introduction to who you are. I can do the same as well. Then we can jump into the questions.
Yeah, that sounds great. So, well, hi, everyone. I'm Sammy Kaipa, currently the founder of an early stage startup called Tingono. And this is an aside, but we build AI agents for the customer success space. My quick, very brief bio is that I have a CS pedigree. Let's say the first, 8 years of my career was spent in various roles in enterprise software. I went to business school. I only say that to tell you that that's where I met my eventual co-founder. And in 2012, we started our first AI software startup called Glimpse It. And then, long story, but I'll make it short, over a 6-year period,
We built a novel product, a lot of things that the speakers were talking about. We built a strong team and a strong sort of revenue generating engine. And in 2018, we were acquired by Forrester Research. So that's my quick background.
Awesome. Thank you, Sammy. And just for the founders and participants here on this call, my name is John Terrio. As Colin mentioned, I work at Nasdaq, been here for 8 years. I lead our talent acquisition and HR business partnership verticals for the organization. And on the side, although it's been more prevalent of recent, been involved in integrations with a couple acquisitions that we've done of recent. So happy to lend any perspective there. I'm going to help facilitate a chat here with Sammy regarding his experience in the sale of his business. Any questions, feel free to leverage the Q&A. I'll do my best to monitor that as we're going through this, and we'll put those questions to Sammy as we go through this. But Sammy, you mentioned your business that you had and the business that you founded. You ended up selling that in 2018. Congrats, on having done that successfully. What were the market dynamics like as you were going through that process at that point in time? And what insight could you provide here to the founders on this call as they may be contemplating a sale of their business?
Yeah. Well, the very brief acquisition story might be relevant to kind of pop into that, but you might be surprised to hear that M&A sort of fell into our lap. We were actually going after our next round of funding when we were approached by an M&A broker who was not a cold outreach. He was, a biz dev partner of sorts. And he had done his homework. And basically, he told us that there were 3 companies who have actively mentioned our company by name in their corp dev meetings. So that was news to us, and it sort of like a light bulb went off, and we were like, okay, like the previous speakers were talking about, optionality is always a good thing. Let's go down both of these paths. Luckily, prepping for an M&A, while it's not exactly the same, it's similar enough to prepping for fundraising. So we had most of our ducks in a row to really test both paths simultaneously. Market dynamics obviously played a big role in our decision to even go down that path, but also like in what we could consider our prospects and our possible outcomes. In my simplistic world, there was almost like in the recent past, there was like 3 eras. One was like something like circa 2016 to 2020. That was when we got purchased. It was mildly exuberant, still like zero interest rate world, right? It was a healthy M&A market, but then, everybody knows that sort of that COVID era between 2020 and 2022 early, everyone did really well, right? If you sold your company then, you had those astronomical sort of multiples and valuations. And then the current era we're in is, it's compared to that kind of astronomical one, and it's not horrible, but it's unfortunately the bad news. It's not the greatest time for M&A activity right now. And I think that basically like the insight for me in this period is that it's a great time to be kind of an early to mid-stage founder, right? If you work on your fundamentals, if you build a credible product, you have high value in a sticky customer base, you're in a good spot for when things turn around. And that turnaround really looks like probably some sort of like repeated interest rate cuts that'll lead to more IPOs, and that's the driver. IPOs drive M&A for at least most of the small and mid-sized companies because these companies have a lot more capital and are looking to invest. So that's the advice: hunker down, build real value in your company now, and wait for the next cycle.
Got it. So the thinking there is some value in waiting for the market to turn around when the climate is more favorable if you are contemplating M&A type of activity. Yeah,
absolutely, and that's even my current thinking for my own company, in fact.
Okay, great. Yeah. As you were working through that sale, getting close to that to happen, I imagine you had to break the news to your team and communicate that. What was that like? What was the reaction that you got there from your team?
Yeah, that's a great question. I think that overall the team was, I'll even go forward and say they were enthusiastic, right? They were actually on the positive side of the whole thing. And I think in our case, a startup where you get it to like a Series B or something like that it's a long slog, right? So there's some burnout from the intense startup work life. And we sort of did the strategy of like announcing it to the team and then having somebody from the acquiring team who was our champion also be there to sort of support the enthusiasm. And so our acquirer, Forrester in this case, really valued them, and eventually they put some serious incentives in place for them as well. So they were happy. So team-wise, there was really no barrier to our deal. They were all pretty happy.
That's great to hear. Yeah, I did gather just from the previous segment, there was conversation around integration and cultures, and I even saw a question there in the Q&A where, these deals can really sort of unravel over time if you don't have the right culture for your organization. To what extent were you sort of evaluating that as you were looking at acquiring companies, or there was interest in your business? To what extent were you thinking about culture and the fit, for your team in the acquiring organization, and how successful that would be, long term?
Well, maybe ours is not a true case study in that sense, because we didn't. I mean, we didn't like largely. No. Obviously, and that's a learning, and this is something I should convey. But so much of the experience we had post acquisition was determined by the deal terms, right? And so I can't stress that enough. You have to negotiate on more than just valuation. And we were newbies. We had an M&A broker, and he sort of helped us along the way. And you have to lean on them for all these kind of learnings. But the design of the terms, like in terms of like, do you have an earnout? Is it a time-based earnout? Is it a milestone-based earnout? To realize the milestones, what resources will you be granted? How will you be working with the acquiring company? And what will your span of control be within that company as well? And then how autonomously can you run, and for how long? So these are all things that, again, I can't say we did a good job of it to get started. And luckily, we fell into a spot where we did have I will say we did have like an initial 2 to 3 months that were kind of rough, sort of figuring out, which internal teams had expectations of involvement with us and so on and so forth. But after we worked that all out, ultimately we felt like we were in control of our own destiny. We ran a somewhat independent business unit, which shielded ourselves and our employees from a massive culture change up front. But for the most part, we integrated, I would say somewhat seamlessly.
Yeah, that's great. Any advice you might share there in that regard? Because the integration piece is sort of interesting. I think both for the acquiring company and likewise, for the company that is preparing for the sale, thinking through how autonomous do you want to be, let's say in the early days of that, to what extent you want to keep your underlying systems, your existing like reporting line structure, the operating model that you built, for your organization. And so as you're thinking about the integration, with the acquiring company, how important is that, as part of the deal? And I think both companies probably are thinking through that. And as someone here at Nasdaq who's gone through it a couple of times, we found that the longer tail integration was a little bit more painful than the ones that were more, accelerated, let's say. But every deal is sort of a little bit different. Any advice you would give to the founders here on this call as they're thinking through the deal terms there and what integration should look like for their business?
Yeah. Well, again, in our particular deal, the level of minutia was just not covered, right? So it was broadly, here's the valuation, here are the deal terms in terms of your earnout, here's the time frame for this, here are the milestones you need to hit to meet those milestones, and then like what will your position be, your span of control, and things like that. We didn't have the level of minutia of here are the systems that you are going to be required to integrate and so on and so forth. So that possibly saved us. I don't know. Maybe it's a good thing to have those explicitly put in. But I think on both sides we were all operating in good faith. So the benefit was that we came in as sort of this autonomous business unit for some time, and we got to do the best of both worlds. We got to keep the systems that we had in place that we appreciated and liked, keep our tech stack and things like that. And then when we didn't like something on our side and they had a better kind of instance or tool or something like that on the Forrester side, we got to avail ourselves of that benefit as well. So again, I think it comes down to operating in good faith. The acquirer while in so many ways the weight of them bears down on you, they also know that, you know, we can't just like, to make this successful, we have to operate in good faith too, and we want to sort of integrate them slowly.
The two-way street makes perfect sense.
Yeah,
totally. You mentioned valuation before for your business. What went into that process as you were negotiating the terms? How did you approach valuation for your business?
Yeah, well, that's the dance that happens way before the negotiations even start. And I think it's sort of, I'm sure everybody, it's well known that you lead with kind of your scalable tech product, right? That's how you ensure the best valuations. I think other speakers mentioned this too. If a company's main reason to buy your startup is for, you know, talent or brain share, i.e. acqui-hire, or, you know, you're a services-based revenue business, then naturally you're looking at lower valuations, lower multiples of your revenue, and so on. So make sure, no matter what, you lead with tech, even if in perception only. I mean, to some degree, right? And on top of that, you lead with what is hot at the moment. And even at that time, it was AI. AI was hot. So we leaned into our AI tech and our capabilities. And, you know, that sort of helped us through the negotiation. And again, this was a dance that happened way before we started to talk to specific terms, you know, through the deal.
Makes sense. Great.
Yeah.
Can you speak to some of the barriers and challenges you faced there, Sammy, associated with closing the deal, and how you navigated through some of those challenges?
Yeah. I mean, I think the best, so we didn't have any like core ones. We had just sort of like disputes here and there over, like I mentioned, span of control, and we were willing to like bend over backwards on a lot of those things because we're really single-mindedly focused on valuation. In retrospect, we should have dug in a little bit more on those things. But I think the overall advice is that, you know, running this process, like after a certain point where you're in bed with this particular acquirer and going through the negotiations, it's very much like a sales process. Like you are selling your product to a customer, right? So you have to, the strategy for mitigating any potential risk in a sales deal as well is just to move with as much speed as you can, right? So I can't mention that enough. You got to move with speed, and you have to just keep the enthusiasm as high as possible on both sides, right? On your side and the acquirer's side, as long as possible, and then do all the little tactics to push that forward. So become best buds with your internal advocate. There's always some sort of internal advocate, the champion on their side. Annoyingly push the deal to get done, and leverage your M&A broker to be kind of that middleman that you know, takes all the brunt of the annoyingness, if you will, right? But at the end of the day, it's finding that champion. He or she has presumably something to stand to benefit from the deal as well, like it makes him look good in the company or something, and just continue with as much speed as you can. Just realize that it's not done until it's done, until signatures are in place, until checks have hit your bank account. You just have to keep pushing.
Makes sense. You mentioned some of the risks there that you were faced with. As you think about talent risks, did you have any situations there where certain key talent, you know, was at risk as a result of this deal being done? And how did you sort of address that and make sure that knowledge was retained as part of this deal?
Yeah, we did have some risks along those lines. I mean, we unfortunately had the misfortune of, you know, integrating and having redundant sort of functions, and we had to let a few people go, so we had to deal through that as well. But on the tech side, because that's clearly where all the IP and the value was, we did have an individual, just one individual actually out of the entire team who, you know, was considering leaving. He had also some visa issues and stuff like that. So it was important to basically have the acquiring unit basically come in and do like a hardcore press on him, right? And it worked ultimately. I mean, I think once you become sort of like best friends with somebody in a C-level position at a publicly traded company that's worth X number of billions of dollars, I think that does the trick. So, use your arsenal of what you can on both sides, on the acquirer side and on your side, to smooth things over. And I think it works. It works out.
Yeah, that creativity, I'm sure, was quite invaluable there in that situation.
Yeah, absolutely.
So just looking back then, Sammy, going through that entire process, you have some founders here that may be contemplating M&A for themselves. Any parting words of wisdom that you want to share with this group before we conclude our chat here?
Yeah. I mean, yeah, I think it's mostly a reiteration, but like market timing wise, I would say now is the perfect time to build a valuable early stage startup, as opposed to going out and seeking an M&A. Of course, it depends on your stage, and what your other alternatives are. But if you can wait out the market for better future outcomes, either, I think of these two next level paths as options, as the core options, which is you either wait it out for a frothy fundraising market, or you wait it out for an acquisition market, raise your next big round, or go for an acquisition. And I think that, market dynamics tend to put those on the same path. So this is the time to kind of do that. And then, I alluded to it, but I think that the next thing is really like post-acquisition, even during negotiation, but post-acquisition, really make an effort to operate in good faith, right? Think of yourself as part of the acquiring company. Try to align your goals with theirs. Make sure that they're trying to do that with you as well. And you will be tested, even against your better instincts. Try to be one team. It's going to make for the best outcomes. You might even be burned. Literally, there could be a bad actor on the other side. But in the long run, it'll be a better outcome. And at the very least, you will have no regrets over sort of your behavior in the whole thing. And I think that's critical.
Good advice, Sammy. We got one question that did come through. You mentioned the broker. How do you find a good M&A broker?
Yeah, so M&A brokers come in all shapes and sizes for all shapes and sizes of businesses. So we were a relatively small company, 15 people at the time of the acquisition. We didn't think we were going to go for, like, let's say the big, Morgan Stanley. I think we interviewed maybe a couple of the big banks. But after that, it really was the personalization from the boutique M&A brokerage firm that came to us that we appreciated and enjoyed. It was an individual who had gone through 4 acquisitions himself personally, and then had started this firm and has done hundreds of since. And he was still the main guy, right? So we didn't enter a firm. We did shop around, and we didn't want to enter a firm where, we were sort of handed off to a couple of associates or something like that. So we brought out the big guns every time we had a negotiation or something like that. So I think that's what you over-index on, is comfortability with the individual and their negotiation skills, and their ability to take the brunt of let's say the ill will that might exist in a negotiation as well.
It's great. It's great. Wonderful. Hey, thank you, Sammy. It was a pleasure speaking with you. Colin?
Yeah,
Amazing.
absolutely. Thank you so much.
John, thank you so much. And Sammy, appreciate you sharing your firsthand insights in this panel. Really appreciate it. Thanks again, fellas.
Thank you. Bye now.
Take care. Bye.
All righty. Before we dive into our final panel of the day, we are going to launch a quick poll. Since this is the buy-side panel, if you are planning on acquisitions, how many are you planning in the next few months? So let us know. This will help inform our expert panelists in the next session we got coming up in just a moment. All righty. Thank you for voting. We'll leave this open for another moment. And that poll. Share those results. It looks like 1 to 3 is in the second place position, but pretty good spread. So without any further delay, please join me in welcoming our panelists for our Growth Through Acquisition Buy-Side Overview and Insights panel. We have our moderator, Roberta Burrows, who's a board member at the Nasdaq Entrepreneurial Center. Hello, Roberta. We've got John Milner, who's an M&A advisor at KPMG. We have Mark Holloway, who's a partner at Wilson Sonsini, and Taraj Parang, president and CPO at Serve. So looking forward to this conversation. Roberta, over to you.
Thank you, Colin. Really appreciate that. Hello, everyone. As Colin mentioned, I'm a board member here at the Nasdaq Entrepreneurial Center. But before we get started with this amazing panel that we have, I definitely want to have our speakers introduce themselves. So, John, why don't you kick us off?
Yeah, thank you. Great to be here today, everyone. I'm John Milner. I'm a partner at KPMG in our deal advisory practice, where for almost 20 years, I've specialized in helping my clients go through the M&A journey. A lot of that is around going through diligence pre-closing, as well as the value creation phase post-close. And I focus most of my work in the technology sector, focusing on both serving private equity and corporate clients. So really happy to be here today.
Thanks, John. Mark.
Thanks, Roberta. I'm a partner here at Wilson Sonsini, focusing on M&A, mostly in the tech sector and other high-growth industries. Do some life sciences work as well. The deal sizes for us range pretty broadly from M&A for startups that have raised a round of financing or so and are looking to exit, to much larger exits for folks that are potentially public or thinking about going public, as well as helping startups acquire other companies as well. In addition to a lot of domestic work, I also work extensively with our London office and do a lot of cross-border deals between the UK, Europe, Middle East, and the US.
Thank you. Taraj.
Hi, Taraj Parang here, President and Chief Operating Officer at Serve Robotics. We are a NASDAQ-listed robotics company. We do autonomous delivery with a fleet of robots that are currently live in LA. I have been an entrepreneur and around Silicon Valley since the late 90s. Actually started out at Wilson Sonsini as a lawyer, then moved over to venture capital and started my first startup in 2005. That one was a wild ride, as they usually are. And in 2008, 2009, we had to do a fire sale, learned a ton of lessons, tried not to repeat the same mistakes with my next startups, and had a very different result as an outcome. Also spent 7 years at GoDaddy running corp dev for a number of our business units.
Thank you all so much. So let's just dive right in. Taraj, I'm actually going to have you start, but this is a question to all of our panel. So if we're looking at the broader M&A market, and we have seen a boost of activity in 2024 compared to 2023, can you all tell us about what your experience has looked like through this year so far, and what are some of the high impact market changes or trends you've seen? Taraj, can we start with you?
Sure, happy to start. So very different market this year compared to last. I'm an investor in a number of venture funds, as well as advisor to a number of startups, and I see their inbound interest increasing. So a lot of acquirers are becoming more active. Last year, I would say very few acquirers would make outbound inquiries, and especially if there were startups that were not cash flow positive. No one wanted to inherit a burn rate. I think acquirers tend to be a bit more optimistic now about the future, and they're looking at making investments rather than just acquiring profits. So it's a very different market. Both corporate and private equity activity is up. And of course, everyone's talking about AI, and you can see that already transforming both the appetite. So a lot of acquirers are interested in acquiring AI talent, AI technologies, accelerating their roadmap in getting into the AI game, as well as using AI tools to be also more efficient in their own processes. That's just some of the highlights from my perspective.
Thank you. John, from an M&A advisor's perspective, what are you seeing?
Yeah, I mean, echoing a lot of the same sentiment, 24 has certainly picked up. I think for us, that pickup really happened in, call it, middle of Q2 of this year with a lot more activity. And if I compare that to 23, we spent a lot of time in our practice preparing companies for sale, people that are getting ready for when that market window opens back up. And in 24, it's been a lot more on the buy side. So actually taking advantage of those companies that prepared themselves for sale. I think in some respects, we're seeing that because everybody wants more certainty around where the market is. A lot of professional investors are going to transact in every market. They just want a little bit more certainty in terms of what is the bid-ask spread between buyer and seller. What am I thinking about from a regulatory market, a cost of capital? I think we've started to see a little bit of that normalize, even if we're at more elevated levels from a rate perspective or the like. People are just waiting to get back to transact. I think the other big issue that we're seeing is when you think about the level of activity of PE in the M&A market, they've got a fun life cycle. They have to sell assets at some point in time. And there's a huge backlog of PE-backed businesses that need to have a transaction just to facilitate that return of capital to the LPs of those funds. And you can only kick that can down the road so far. And we're going to start seeing more and more of those come to market just because they have to.
Got it. Okay. Mark?
Sure. My experience has been similar to Raja's and John's. For me, 2023, like John, spent a lot of time preparing companies for sales, going through sales processes only to have, either no buyer show up or no buyer with a price that seemed remotely attractive. And for the acquirers that we were working with, it was pretty easy to kill a deal, whether valuation concerns, diligence issues, people got spooked pretty fast. I think there was a concern about, doing the wrong deal, maybe valuations hadn't settled yet. And one of the things that's really surprised me about 2024 is the extent to which, especially on the strategic buyer, corporate buyer front, they've got their corporate strategic objectives and they're very committed to satisfying that through M&A. Been a number of deals where I looked at it and thought, man, this is going to be hard. Diligence, tax, other challenges, and people stuck with it. They took longer than they'd like, and they were hard, and there was just never any sense of wavering that the buyers were going to do it. Compared to last year, where it didn't take much and things quickly fell apart.
Thank you. Thank you all for kind of adding to that question. And this is a great segue to you, John, in terms of tell our audience some of these war stories that you have around kind of thorny due diligence issues this year. What are some things that buyers should be keeping in mind, particularly for deals coming up this year?
Yeah, certainly. I think Mark had a really good point around it was really easy to kill a deal last year from diligence. And what I'm seeing, as we kind of go into 24 from a diligence perspective is the processes are taking longer. And I think that is healthy. If we roll back the clock 2 or so years, it was how quickly can we do this and how many corners can be cut, if you will. And we're seeing people take a lot more time to due diligence, which is really important. I'm not a tax expert, but I'm seeing a lot more tax matters come up in diligence that are becoming very thorny. I think part of that is just the level of sponsor-backed businesses and the amount of structure that they put around them in terms of taking certain positions that kind of come out of the woodwork. But outside of tax, and maybe a more important topic is diligence around the customer. We are in a stage in the overall macro environment that can become more challenging, and people are really questioning what is the future and how do I drive my investment here? And so a lot more focus around, are the customers still really growing? Am I having to invest in really new customer acquisition? Or can I still rely on a certain level of expansion and cross-sell in my customer base? So double clicking even further into that customer dynamic, just because the underlying customer is changing. A lot of businesses we're seeing, they're not upselling and cross-selling as much as they used to. And the sales cycle is becoming longer. It's becoming more expensive to acquire new customers. And so that has a play in terms of how strategically important this asset is to the investor. So.
Got it. Understood. Going to have a little bit of a pivot here in terms of talking about the subject that everybody can't get enough of. With the rapid adoption of generative AI across the industry, some people think about it as a utility even so much because it just is totally industry agnostic. Mark, how do you see this affecting M&A activity, particularly around activity, structure, and terms, and even double clicking on how should corporate dev teams think about Gen AI adoption and usage for their target companies? You speak a little bit on that.
Sure, something we're talking a lot about these days. We're really in kind of a gold rush period, right? There's the perception that, especially for the biggest technology companies, if they don't have a good AI story to tell, there's tons of articles about, oh, they're behind and they have no strategy here, and so there's a lot of pressure for some of the biggest technology companies to have a clear, AI story, and for that to continue to be, progressing. Part of that is driven by the sense of scarcity, right? There's only so many really people perceive as really good models out there. There's a barrier to entry in terms of how much it takes to create those models, how many resources go into that, how much you've got to spend on chips, to be able to run those things. And the people that create the models, it's not just your average person who can do coding. These are PhD level mathematicians and things like that. That again, there's only so many of. So right now, there's a lot of excitement, a lot of fear. Some of the acquisitions are, hey, it's an opportunity. Some of it's defensive. How's that play out in terms of what the deals look like? Lots of talk, lots of activity. People are looking to make sure they've got a piece of sort of a scarce resource, whether it's at least a license to use it, maybe bringing the whole thing in-house. Certainly impacting pricing. If you feel like there's only 2 or 3 good, things out there, then you get away from, fundamentals and, financial metrics. It's like, well, how much do I pay to avoid an existential threat of, not being able to have any play in this market? Seen a little bit of creative structuring. Folks who've been looking at it closely have seen there's been a few what people are calling reverse acquihires, where a lot of the employees of a generative AI model company are being, taken with a big license payment paid to the company, and a license to use the target's AI. Sort of reverse acquihire, because I think they're not actually being acquired. The company itself isn't, but a lot of the assets are essentially moving over to the buyer. Thinking about if I'm thinking about this from the corporate development standpoint, how do you think about that? First, I think sort of table stakes. AI is so popular now, right? So much of the companies we're seeing getting funded have AI as sort of part of what they purportedly do now. For some, that's really part of the story. For some, that's just kind of stapled on there like an SEO search term that's not really fundamentally part of what's going on. So part of this is from a corporate development perspective of you got to cut through and say, is this integral to what this company is all about? How recently was it adopted? How much of the story going forward is true? I think once you get past that first level of, is this real? Then you've got to think about some of the unique issues that generative AI poses. Is it using intellectual property that it's got rights to, or is it infringing on other people's intellectual property? Is it using data in a way that it's actually got the rights to do, or are you going to have data privacy issues? I think there's also some like AI specific regulation. Can you use it in hiring people? And some states and cities have adopted new laws that limit, your ability, or put some rules around your ability to use AI, to screen resumes and things like that. One of the most interesting things about this, I think, is generative AI isn't like software in some ways. It's almost like an HR consideration. You're in some ways sort of hiring an employee. And what is the personality and character of this thing? How easily can it be sort of tempted into doing stuff that could have real reputational issues, right? Where it's generating, words or pictures that are, very much not what you hoped people would do with it or what would use it for, and are, really challenging reputationally for your company. That's a kind of unique a facet that you didn't run into with other software issues. One thing I haven't seen come up yet, but it sort of sticks in the back of my mind, is so much data goes into these things. The algorithms are complicated. And we haven't really seen this come up yet, but it's the kind of thing we worry about since, we're in the business of kind of assessing risk. Is what does it look like if it turns out that the data that a model's been trained on, or the way the model works, is so fundamentally problematic from a legal compliance perspective or another reason where it just can't be saved, right? And so you have this asset that has a lot of, could have a lot of value, except for the fact that it's going to create, more liabilities than benefits, and that you'd have to sort of start from scratch. Haven't really seen that happen, but it's the kind of thing I worry about to say, how do you assess this risk, and how do you guard against it?
Thanks for that, Mark. So kind of just going back a little bit and double clicking down on some of the technicalities of things that you've seen, can you shed light on like terms and how they've evolved from 2023 to 2024, and how might corporate development start thinking about, acquisition timing? And, we could talk even a little bit about how valuation play looks in terms of what it was in 2023 versus now. Want to kind of dig deeper into that perspective.
Yeah, sure. For me, one of the biggest functions of the deals I've seen this year is so many things were a mix of cash and stock. Cash being a little bit more precious to use, fundraising being challenging, interest rates being up. People are mindful of that. And so a lot of deals involving a mix of cash and stock. And stock can be a really great currency if that's, what you want to use and you've got it available and you feel like it's fairly priced. Create some issues around tax and other things that have to be solved for. I'd say that was one of the biggest things I saw. Valuation's obviously a big, probably the biggest term. What I saw a lot this year was that valuation, people's expectations came into alignment after being out of alignment in 2023. A lot of the deals that I've done this year or I'm working on this year are conversations that started 12 to 24 months ago, and people were not on the same page. And so folks have had to go out and do fundraising. They've run processes. They realized, hey, I still had the valuation in my head from my 2021 raise, or the potential, price that a SPAC was willing to do a deal with me at back then. But that's really in the past now. This is the here and now. This is what I'm worth. I've got a better sense of what that looks like. And so people that weren't on the same page 12 months ago are now sort of violently in agreement that these numbers make sense, right? And the numbers haven't changed much. It's people's expectations. In terms of how corporate buyers should think about these things, it kind of depends on where you're at in your journey. I've talked to a lot of folks this year who are just thinking about M&A for the first time. And that's a different conversation, because then it's a question of, okay, well, what's the strategic priority that you feel like you can only achieve inorganically, through acquisitions, the right way to do it? And what sort of infrastructure do you want to think about building around acquisitions? If you've already got a lot of that infrastructure in place, you're at a different spot, and then you're thinking about, okay, maybe I want to really ramp up activity now before M&A activity is picking up. It's still, at least for me, certainly slower than 2021, 2022, getting back to the sort of pre-pandemic levels. Do you want to try to get some deals done before things hopefully pick up next year?
Thanks for that, Mark. And I know you talked a little bit about how people are getting a little bit more realistic regarding their valuation. So, John, I'm going to pivot to you from an advisory perspective. How have you seen negotiations around valuations and purchase price adjustments play out in 2024 so far? And, even more so, do you have any predictions for 2025, since there's just been an overall change in the industry?
Yeah. And you've heard it. Mark just touched on it. Sammy talked about it a little bit earlier in the fireside chat. There's this expectation gap that's closing. If you go back to 2021, early 22, people could sell almost anything for a very large valuation. And that, bid-ask spread was really stretched in late 22 and into 23, with buyers realizing the market's different. The SPACs aren't there. There's other macro issues. And so we don't think the valuations are where you thought they used to be. And I would agree with Mark that I don't think the numbers have changed much over the last, call it 12 to 18 months. It's more the perception, at least on the sellers, that yes, the market really has sort of reset to a new normal. They have come down a little bit more. And I think that has overall helped the volume of transactions, which has been really helpful. And I'm seeing a lot more clients spend more time negotiating valuation in the term sheet stage versus later on, which I think is healthy because they're getting very real around where it is. And if I think about where that goes into 25, I don't know that we're going to have a huge increase in terms of valuation multiples if you think about a revenue or an ARR, an EBITDA, or some other sort of benchmarking multiple. I think it's more this realization that this is where the market is. Let's see what broader Fed does around rates and other things as it impacts that cost of capital for all the market participants. But that we're finally realizing that we were, no one uses necessarily the term bubble, but we were in a very elevated period and we're now in a new reality, and everybody's got to kind of adjust to that reality. So I think that's healthy. I think we're seeing a lot more of that discussions up front. I think people are going back, buyers are going back to sellers they talked to earlier if they really like the asset. I think that's actually something really important today, which is I saw a lot of clients in the kind of right after the pandemic period do deals because everybody was doing a deal. I think that helped boost some of the valuation methods. And now you're seeing a lot more acquirers and investors really thinking about, why am I doing this deal? What's the strategic rationale? Is this really the right asset for me? And if it is, like, we can play a little bit of the long game, be involved in processes, and be there to kind of take advantage of that when the market's right. So that's where I'm kind of seeing, and I don't think we're going to have a huge change. I think we're going to have more people willing to transact at where the market is today as we move over the next 12 months.
That's very, very insightful. And to kind of double click on that even more so, obviously we've been talking about valuation, but I'm going to have another question to all of you, and I'll start with you, Taraj, just in terms of what are some of the metrics that are most critical to measure these days when looking at new deals?
And actually on that valuation point, just wanted to add to what John said. Valuation, no two companies are this, comparable. They're each unique in their own ways, and valuation is very unique, and it's both an art and science. I think when the market is giving public companies a better multiple, if the public company is feeling a bit more that they are valued rightly by the market, they tend to be also passing on that to the companies that they acquire. They tend to have more degrees of freedom, kind of moving on valuation. It becomes less of a sticky point. When the valuations are depressed in public markets, that's when you see a lot more hand-wringing over the valuation conversation. So I think if the market trends continue, the public markets sort of give better valuation. And also, what is the valuation based on? It used to be at some point that, like, if you were high growth, you had a better valuation, and so that kind of also translates into how they evaluate targets, right? So they provide a premium to the target if they're fast growing versus target that's slower growing but more profitable. Speaking of profit, I think that's one number that I think is going to be quite important going forward. Even though I would say acquirers are more optimistic, they're still looking for not inheriting too much of a burn. Maybe they can sustain some burn in the short term. So if there are companies that are losing money, but they need to kind of connect the dots and show how through either cost synergies, revenue synergies, or both, they can get to a point of cash flow breakeven and profitability in the 12 to 18 months horizon. If it's pushed out beyond that, I think it will hurt on the valuation front. I may not actually get the deal done.
Thank you for that. Mark, some metrics.
Yeah, my experience has been, at least this year, for corporate buyers, not that financial metrics don't matter, but they've generally been driving towards some strategic goal. Whether it's I really need sort of smart people that can create new technology, whether it's the technology that exists. In some cases, it's I need to augment my product line, and they've got a nice piece, right, that kind of really completes the picture for me. So for them, generally those deals have felt more about like there's a specific asset or that was really attractive about that deal. the private equity folks, in my experience, tend to be a lot more driven by the metrics, right? Their focus is narrower in terms of just returning the best outcome they can to their limited partners. There, it seemed like growth rate, matters more. It's not so much where you're at, but where are you going in the current environment, and how much and how quickly can you grow?
John, rounding it off for us in this particular question, additional
Yeah,
metrics.
and so I always like to start this conversation with one of my clients around what is the strategic rationale? And Mark kind of hit on this, is like, why are you really looking at doing M&A? Is this a strategic thing? So I need a piece of technology, in which case there is no metric that I can go look at. It is a purely technical or talent sort of driven item. Other times it is, I need revenue growth. I need some sort of synergy in order to make it work. I need to bring two products together. I need geographic expansion. I need something else, or you're purely a financial investor. But if I think about actual real metrics that are quantifiable, I'm seeing more focus around what is cash flow and what is profitability. You used to be able to have huge cash burn so long as you had growth. And if you don't have a path, as mentioned earlier, like to profitability, it's going to be really hard. People don't really want to fund this sort of unlimited user acquisition or grow at all costs sort of models anymore. Like they're worried about what the end game is. And so we care about growth rates and really double clicking into the customers. And are you profitable on a cash flow basis? Or what is the path to profitability there? That's what I'm seeing more and more focus around. And really doing more effort and diligence than people did before, where before it was, okay, I kind of built a model, I sort of understood it, but really now diving into, as I kind of mentioned earlier, what's actually happening with that customer? What really is going on with that product? How do I really look at customer overlap for the strategic clients and say, do I really have enough cross-sell here? Where are my sales reps or my AEs or whatever role you want to call it, going out and going to attack? Like, how do I start thinking about some of those integration points so that I can drive that synergy level? Most of those synergies are frankly revenue versus cost. I'm not a big fan of cutting your way to profitability or cutting your way to making a deal make sense. I normally think about it in terms of growth, but that's what I'm seeing in terms of metrics these days.
Thank you all for sharing that with our audience in terms of some of the key metrics that are important as the space grows and continues to kind of come back to some sort of normalcy this year. I actually want to do a little bit of a transition and talk to our founder on this call today, Raj. You wrote a book, Exit Path, How to Win Startup Endgame. You shared practical framework for implementing an exit strategy early in a startup's lifestyle. So given today's hyper-competitive environment, what's some of the advice that you can give to our founders on the call looking to align their exit strategy with the market dynamics, a lot of the things that we've talked about today, the acquirer expectations, particularly when it comes to maximizing what I'm going to say is a realistic valuation?
Yeah, well, thank you for that question. And yes, absolutely. I wrote this book, Exit Path, because I actually wish that this book existed with my first startup, and I would have had a very different outcome. But hey, if others can avoid the mistakes I made, then it's a win-win for everyone. One of the biggest lessons I learned with that first entrepreneurial experience was that you need to embed your exit strategy into your business plan from early on. It's not something that you spin up 6 months before you run out of money, or when you feel like you want to sell the company. This is something that takes years and years of advanced preparation, and the sooner you start, the better. In fact, think of it as like just like the part of your business plan, really. And when you do that, you kind of align your business growth trajectory with potential acquirers' interests, and you actually find out who are your potential acquirers. Go out there, build relationships with them, and try to validate some of your hypotheses about who could be an ideal acquirer and why they would be interested in you. once you have that knowledge, then you can actually start developing milestones and even position your company in a way that would set you up for success whenever you enter into those acquisition conversations. And you may be ready to sell, but an acquirer may not be ready to buy you. They may be busy with other things. So you have to kind of be on the radar so that the optimal timing can sync eventually. So there's a lot that's out of your control, but building relationships with acquirers and getting started early, getting your internal stakeholders aligned around what success looks like are things that I highly encourage founders to do no matter when they think they want to sell their startup.
So in addition to that, you talked a little bit about what I'm going to ask next, but are there any additional sort of critical steps, like particular things that you think founders should take into account and prepare for this due diligence process? We talked a little bit about the pitfalls. You said, don't wait till the last minute. What are some of the other things that you've seen or that you would like to inform our founders to think of if they're looking to execute their exit strategy? And how can they avoid those things?
Yeah, doing a proper sale process is not a DIY project. So I would definitely encourage founders to surround themselves with the right team, both internally, have a layer of management that actually can keep the train running while the leadership is focused perhaps on the M&A conversations. It can be very distracting. And the last thing you want to happen is that while you're in the middle of these conversations, something goes wrong, you have a breach, you have some failure, and that just you lose all leverage in negotiations if a mishap like that happens. So you want your execution to be solid, you have the right team members, and also have the right advisors from legal to accounting to perhaps even investment banking. You want to have all these advisors that have gone through this before and are experts in their field, and you have interviewed them, you have built relationships, and you can pull on them when you are actually starting to have those serious conversations. Again, there's a vetting process, there's a getting to know, reference checks, all that. You need to do this way ahead of time. Also, you need to get your documentation and processes cleaned up, because once you're in the middle of these negotiations, diligence happens fast. We've mentioned that word a few times, but basically acquirers will want to take a look at under the hood and take a look at your documentation, and they need to be organized, your financials, everything. You don't want to be panicked about running a forecast and things like that while you're having those conversations. So you want pretty buttoned up data room and all your documentation, everything in order, so that you have much more important things to worry about at that point. You don't want these things to get in the way.
Thank you. Thank you for that, Taraj. And I know there were some other questions that I wanted to discuss with you all, but given the time, we have quite a few audience questions. So if you all don't mind, I'd love to jump into those questions with the audience. Or is everybody okay with that? All right.
Absolutely.
Okay. So great. So the first question, I am new to fashion and retail and considering acquiring existing retail companies. Do you have any insight for this industry and what should I consider? I'm guessing that would be a Mark or a John.
Both much more fashionable than I am.
I'm not sure that fashion's necessarily my thing. What I would say is you need to know the industry really well. And you need to know the assets and why you're buying this, right? If you don't have a great sense for the dynamics of the industry or the particular business model, that is really kind of a recipe for failure. And it's a really expensive way to fail. It's much easier to start something, iterate, to have small failures and keep going versus the really big, expensive, go buy something and have it not work. So I think as you think about fashion retail, I would be thinking about what we call them market studies. We call it commercial diligence. It's really about where is that particular target or those assets going to continue to grow. because you don't necessarily want to be buying in at the top of a particular cycle for a particular brand or type of brands or area. So I would spend more time around the advisors that can help you with market studies, commercial diligence, to really understand that area of the world from a retail perspective. I mean, Mark, I don't know if you've got more to add there.
Yeah, no, I absolutely agree with John. And I think the advisor that's going to be probably the most helpful there is going to be somebody in the sort of financial advisor, investment banker space, to at least give you some thoughts on, how are businesses in the industry valued? And then thinking about, based on what are you looking for, right? Do you want just the designers? Do you want their retail space? What is it about them that you're looking to pick up? And then you can think about, well, how much would it cost to build that on my own as well, right? And what are the sort of best 3 targets to go after, depending on what you're looking for, so that you've got more context for, is this a good deal? If I don't do this deal, what's my alternative to it? Makes it a lot easier than feeling like, hey, I saw this target that looks attractive, but if you don't have that broader context, as John said, it's sort of easy to do a deal that in retrospect doesn't feel like a good one.
Thank you both. So next question, very interesting, since we were talking about profit is a key metrics, but what's the best way for a non-revenue generating company to attract and know what acquirers are purely looking for, like a piece of technology or IP? Like what is the best way to attract acquirers if you're not generating any in revenue right now?
I can take a stab at that.
Okay.
So basically, I would say the best way to attract them is, first of all, to make sure they know about you. How do you get yourself on their radar? It could be you just approach them, you find the right people within each of those companies, and you reach out to them. If you can't find out or navigate their org chart necessarily on LinkedIn, then maybe the best thing is to reach out to their corp dev or biz dev teams and be upfront, say, hey, I'm starting to build relationships in this industry and wanted to kind of compare notes with my counterparts at your company. Who would be the best person for me to talk to? It's actually the best way to build relationships when you don't have an immediate sales or pitch or immediate need. People tend to be less defensive when you approach them that way, and it's just in the spirit of building relationships for the future collaboration. Other things are, depending on your budget, you could do PR, you could join competitions. I mean, I don't know what stage your company is at, a startup is at, but there are ways figure out ways to get in front of potential acquirers.
Taraj is providing great insight here. Having a founder on the panel, I think, is invaluable. And I want to connect 2 things he's saying, because it might not be obvious to folks that if you haven't been in a big company before. Taraj mentioned, hey, you don't want to start this process of thinking about how you're going to sell your company 6 months before you run out of cash. And you want to be making connections with, corporate development, business development people at companies that might buy you. And there's a sort of connection between those 2 ideas, which is, earlier I mentioned, a lot of these deals are being done based on companies and buyers trying to fulfill strategic priorities. Those don't get set overnight. And if you're not part of somebody's strategic priority for the year, right, your pitch of why you make sense, it's a lot harder to get a deal done when you want to get it done, right? To wake up one day and say, hey, I should sell to this company. Well, they've got a plan for this year. And if you weren't on it at the beginning, it's got a lot more layers of approvals and kind of running it up the chain to socialize. Well, we agreed on these priorities, but now we're going to do something that's different. It might be a really good opportunity, but those wheels take a while to get in motion. And so laying that groundwork, years before you want to sell, gives you a much better chance of like, hey, we really want to acquire this company or somebody like it, right? Have that in people's lips on January 1. So rather than trying to raise your hand when you're about to run out of cash or decided you want to sell mid-year, when it's going to be a steeper hill to climb.
Thank you both. To say that this conversation has been insightful is kind of an understatement. Just before we end, I just want to appreciate so much of the wisdom that you're dropping to our audience here today. Oh, we have some more questions. This is great. So talked a little bit about this, but maybe want to double click on some of the things that you're seeing with respect to challenges and issues with purchase price adjustments between the buyers and sellers. Now we talked about that though, with the rationalization, but are there any key things that either one of you want to talk about with regard to that question?
Yeah, maybe I'll take a first stab around purchase price adjustments. I spent a lot of time looking at them, and I tend to think about purchase price adjustments as trying to make the parties neutral. I mean, that generally is the guiding principle that I'll go to instead of making it shift economics from one party to another party. I think it's about being very clear with the expectations, though, going into how you're setting the definitions around cash, indebtedness, working capital tend to be the three most important that get adjusted for in purchase price adjustments. I think one of the things that I'm seeing that I'm not necessarily the biggest fan about, because I think it can incentivize some misbehavior on one party or another, is this idea of capping the purchase price adjustments. And I've started to see it on the seller side with them capping it at call it an escrow amount. And Mark probably has a little bit more thoughts around this, but now we're seeing buyers cap it the other way, and they tend to be fairly small dollars or percentages, which really means there really isn't much of a purchase price adjustment in a lot of these transactions. And I think that can lead to some bad behaviors of folks. So I think it's just about being upfront with intentions and trying to make it somewhat neutral unless the parties are trying to somehow game it.
Yeah, and it's having somebody like John involved is critical, especially if you don't have a really strong finance and accounting team in-house. One of the first things we do when we're looking at a draft of a purchase agreement is collecting all those financial terms and bundling them together and making sure that whichever side of the transaction we're on, that everybody's really carefully reading those and thinking about it. And sometimes people are like, yeah, it looks fine. I'm like, no, we're going to go through every one of the 17 subclauses of the definition of debt and think about, like, what does that mean here? A lot more important on the sell side, where it could be a surprise that, hey, it turns out you got a lot of deferred revenue and you weren't thinking of that as debt, and suddenly that's a big purchase price adjustment. That's one of the easier ones. There can be some subtle stuff in there that you don't want to be surprised. Whatever the deal is, people should be upfront about it. But again, John and folks like him are the ones that are the most helpful. He didn't pay me to say that. That's just my
Thanks, Mark.
If I may also share a couple of one story, actually. So when we think about purchase price adjustment, we usually think about acquirers reducing the price because they now do diligence and they find things that they're saying, well, wait a second, this isn't how it was presented. Therefore, we need to go back to the drawing board and give you a different price, usually a lower price. And that happens because term sheets are non-binding. And so whatever valuation was on the term sheet is always subject to negotiation as you go through the process. Now, I was faced with a situation as an acquirer where while we're during the process, the company ended up doing extremely well because of some market situations. So like their revenue jumped twice beyond what they were forecasting. And so the seller at that point said, you know what, I'm no longer interested in selling. And so in order to entice them to come back to the table, we had to give them a much higher offer. So we adjusted the price upwards for them to come back to the table. So it can go both ways. And that's actually one of the reasons preparation is so important, because if you align things right and you're actually at an inflection point where your company is doing well, you may actually be able to, as a founder, be able to get a better price than was even on the term sheet.
Thank you. And we have more questions, but I'm just going to ask two more. One is an actual continuation of the price adjustment question. It was someone wanted to understand what is specifically meant by capping purchase price adjustments. What does that term mean? Can one of you tackle that?
Sure. So, as you think about, there's a headline price, we're going to go pay $1 million for this business. And then there's these adjustments that happen through the mechanisms. It's typically cash, working capital, and debt, which are meant to adjust for the day-to-day ongoing operations of the company, plus minus how much cash is left in the bank versus how much receivables and who gets the credit of that cash versus who's paying the payables sort of deal. And normally in a situation, the buyer pays every dollar for cash. So however much cash is in the bank when they buy it, they pay for it, dollar for dollar. There's no monkeying there. There's debt on the business, so we take that off the top and we say we deduct it for all the debt. And then we have a working capital adjustment that says you should deliver me X dollars of working capital, and whatever the plus minus is the adjustment. And so when you start adding all of those adjustments up from what you paid initially at day one, when you kind of went into close, because it's always an estimate, because there's always a true up, you think about, well, what is the delta in cash? Like how much cash was really there versus what I estimated? And where was working capital actually versus where I estimated? And where was the debt? And you add all those up and you come up with a number that gets adjusted for after you close. So everybody's really happy. You sign the documents, and then some period later, cash is transferred between the parties, the buyers and sellers, and everybody celebrates, but that was an estimate. And then some other time later, you have a true up. And that's what we mean by that true up, is that piece that moves at the end. And by capping it, what I'm seeing is some sellers are saying, the maximum extent that you as a buyer can come back to me for is whatever I put into an escrow account. And if you don't use it all, I get it back. And then I'm seeing buyers say, well, it's not fair for you to have a limited exposure and me to have unlimited exposure. So I want the same cap on my side. And that's what I mean by that concept there is, if all of a sudden you thought there was $1 million of cash in the bank and it turns out there was 1.5, but so there's a $500,000 adjustment in this example, but your cap was 300,000, some party's better off by 200, and they really shouldn't be. Hopefully that clarifies it.
Thank you for that, John. So we have time for one more question. Obviously, I always kind of end it with what you sharing a piece of advice, but this question, I think, hopefully you can see me, is something that goes back to our favorite subject, AI. So Taraj, I'm going to ask this for you first, and then I would love the rest of the panelists' insight. So what are the best resources for finding, and this is an audience question, for finding and identifying IT companies with robotics and AI expertise for acquisitions? What is?
I would say just following the industry news and seeing who's doing what. I mean, robotics now, which is embodied AI, in my opinion, is everywhere. And so you have robotics in manufacturing and logistics, and there's just Cambrian explosion of robotic startups. So there's no shortage of it. It really depends on what vertical industry you're particularly interested in, and then sort of looking at the players in that space. I don't think there's like a particular directory you would necessarily flip through, but it's just being close to the industry news.
Thank you. And I said IT, but what they were saying actually was IT companies with robotics and AI expertise for acquisition. So you did answer that. So John, Mark, do you have anything to add to that?
Yeah, the other thing I would just add, and I agree with everything Taraj said, the corporate development function, right, is one that you can outsource to some extent by working with an investment banker. But it's incredibly useful, and it's important if you want to be buying a lot of companies. And so this is a conversation I often have with folks about, hey, do you know any companies I should buy, right? I'm like, well, maybe, but that's not really my role. And more importantly, you should think about how you want to do that, right? So find a friendly banker, talk to them, talk to somebody at a PE fund, folks that their whole job is going out and scouring the market, in particular industry verticals, and understanding all the opportunities that are out there. Now that's not going to happen overnight. I think another way it could be really useful is look at, what venture funds have invested in robotics companies, right? And then just go look at all their portfolio companies as a good way of starting to get a sense of what does this ecosystem look like? Who are the repeat players? Who are they touching?
Yeah, maybe just real quickly to add on that. I mean, whether you have a corporate development function or not, all of my strategic clients, they always have a list, and everybody has a list that they're tending all the time about companies that they're interested in. Companies come on and off that list. And so what you find is it's rarely hey, now I want to go buy something in this space. It's something that's been curated over time of, we're tracking these businesses. We're finding, we thought we liked A, but turns out we did some more research and we found B and we like it. So a lot of that just is research in the industry that people are doing on their desktops, whether or not they're using an investment banker or not. I mean, those are great resources, but the people that don't have those relationships, just kind of keeping that list and thinking about it and doing desktop research helps.
Thank you. Thank you all. And Colin, I know we're a bit over. This has been such a great panel. So wanted to turn it over to you. And for those who I didn't get to your questions, we can circle back with the panelists and pass them along and try to get you some answers. But just wanted to call you in, Colin.
Well, thank you so much for leading such a great discussion, Roberta, John, Mark, Taraj. Incredible insights and continuing the optimism that we started this morning. So really appreciate all of your time today, and thanks for sharing your expert knowledge. Awesome. Well, for those of you who are still on, and we covered pretty much every base on M&A today, but if you're interested in booking a meeting to follow up with any of our partners, I'm going to launch this poll. So let us know. But again, to our panelists and to everyone on the call, from everyone at the Nasdaq Entrepreneurial Center, we thank you for joining us. Hopefully this is valuable, and we look forward to welcoming you all back online soon. Thanks again, everyone.